ITM, OTM, ATM.
Okay.
I don't know what these terms are.
This time value will keep on decreasing and on expiry, this time value will become zero. This is the only constant in market. Intrinsic value cannot be below zero. It cannot be a negative number. All these are called out of the money options.
Okay.
One question, if you want to calculate the time value for 22,500 Nifty strike, so what will be the time value?
Hello everyone and welcome back to the channel. This is Nimisha and we have Zubin with us.
Hi.
Zubin, in the stock market, I've heard a lot of people talking about ITM, OTM, ATM.
Okay.
I don't know what these terms are.
Huh.
And I really want if you can, just throw a light on them and
Okay.
explain me and the viewers about the
Alright.
same. But before you begin, I would like all the viewers to like and share this video with all your traders and investors friends and subscribe to the channel so that you do not miss on any other updates.
Great.
Yeah.
So ATM, OTM, ITM, what are these? First, they are the abbreviations. ATM, you might think of ATM as a, money making, money,
Yeah.
take cash withdrawal machine. It's ITM meaning it's in the money option.
Okay.
In the money.
Hmm.
All right. Similarly, there is something called as OTM, meaning out of the money option. And ATM meaning at the money
Okay.
option. All right. So what are these? Basically, these ATM, OTM are associated with the value of the option, that is premium. Now, when we are talking about premium, all right, so option premium, how is this calculated? If you look at this particular site over here in the options, we have, let's say, 23,000 strike price and their call is trading at 172 rupees. 170 rupees to round off. All right. When we say 23,000 strike price, the premium is 170 rupees. How is this 170 coming in?
Yeah.
So basically premium, there is a formula. Premium is equal to, it has two components basically. One is called as intrinsic value plus the time value. All right. Intrinsic value plus time value is equal to premium.
Okay.
Now let me first talk about time value. Time value is nothing but, the theta decay.
Yeah.
This time value will keep on decreasing and on expiry, this time value will become zero. This is the only constant in market. And that is the only guarantee in the market that time value on expiry will become zero. All right. Now, how to calculate intrinsic value then? So to calculate intrinsic value, okay, this is nothing but the spot price
Okay.
minus the strike price.
What is the spot price?
Spot price is the actual price in the market.
Okay.
You remember we have two market segments. In derivative, there is one derivative and the other is a cash market. So cash market is also called a spot market.
Okay.
All right. So the spot price of the underlying asset. So over here, if we talk about Nifty, so Nifty future price is trading at 23,111. All right. What is the spot price of Nifty? So you can see spot price of Nifty is 23,024. Right? Did you understand?
Yeah.
What is the spot price? So spot price minus the strike price
Is the intrinsic value.
will be the intrinsic value. Now imagine the spot price is right now at 23,050. Yeah, that is the spot price right now. If it was to expire today, if Nifty was to expire today, all right, we have selected 23,000 strike price. So what will be the intrinsic value?
50.
Intrinsic value will be 50. So now in this premium, out of this 170, intrinsic value is 50. Then what will be the time value?
170 minus 50.
And that is
120.
120. Absolutely right. Now this time value 120, no matter what on expiry. Okay. What is the expiry for this particular option? So for 23, on 23rd of January, this particular option will expire. Meaning on 23rd, that is after 3 days, after 2 days now, this time value 120 will become zero, no matter what. Okay. Now let's assume you have bought this particular call at 170 and now since this particular, before I move further, the main question was, what is ATM and
ATM,
ITM? In the money, any option premium has some intrinsic value. In this case, if the intrinsic value is greater than 0, if it had some intrinsic value, that means that option is in the money.
What does it mean?
It means that if it was to exercise today, if the option buyer has to exercise today, he will get some value, that is rupees 50.
Okay.
He will be in profit. And that is called as in the money option. All right. So any strike price, intrinsic value is equal to spot price minus strike price. And it has to be a positive number. It cannot be below, intrinsic value cannot be below 0. It cannot be a negative number. It can be either 0 or above 0. All right.
Yeah.
So if a particular strike price, let's say instead of 23,000, you take a strike price of 22,000. So 23,000 minus spot price minus 22,000, you will get a positive number. So that means 22,000 is considered to be in the money.
Okay.
All right. Now, if you take now this 23, the value is very high. So at the money, what do you mean by at the money? Now over here the difference is really very less, 23,050. So you can consider if spot price was somewhere around 23,020 and strike price is 23,000. It's very nearby. So this particular strike price, when spot price is at 23,020, this will be classified as at the money option.
Because it is nearer to
nearer, very near, and the intrinsic value is very close to 0. All right. Now, if the strike price, if you choose a strike price which is greater than the spot price, so if you select 23,100 strike price, so spot price minus strike price, you will get negative intrinsic value.
Yes.
Negative cannot be there, so we'll take it 0. So this particular strike price is called as out of the money. Did you understand?
Yeah.
Did you understand ATM? All right. So if you check this particular option chain over here, 23,100. 23,000. So any strike price which is below 23, above 23,100, 23,150, 200, 250, so on and so forth, all these are called out of the money options.
Okay.
And above the spot prices 23,050. So to 23,050 will be said as at the money option, call option. All right. And all these strikes above the call option, they are all in the money options. All right. So if you were to calculate, let's say now, did you understand in the money? All right. Now one question: if you want to calculate the time value, all right, for 22,500 Nifty strike. So what is the price? Price is 604. Let's round it off to 600. So what will be the time value? 22,500. Premium is
600 rupees.
600 rupees. All right. Spot price right now is somewhere around 23,000 rupees.
Yes.
All right. Intrinsic value is equal to
spot price
minus strike price. All right. So 23,000 minus 22,500, that is equal to 500. So premium is equal to intrinsic value plus time value. Intrinsic value is 500. So what is time value? 100. Now if you suppose, okay, today you buy this particular call option by paying a premium of 600 rupees. All right. Why are you buying this call option? Because you feel that prices will rise even higher. And on expiry, let's say after 2 days, the spot price changes to 23,200. What will happen? Or instead of 200, let's say, first of all, tell me, when you are buying this 22,500 call with a premium of 600, where will be your break even?
22,500 plus 600.
Absolutely. So that is how much? 23,000?
23,000.
23,100.
100.
Okay. So if Nifty was to go up by 200 points, what will be the premium at that point of time? So for that, we have to calculate, premium we have to calculate, right?
Yeah.
Which is equal to IV
plus
TV.
TV.
All right. TV, you know that on expiry, it will become 0. IV will be spot minus strike. So if the spot price or the expiry 23,200 minus the strike price 22,500, 500. So what does it come to? 23,200 minus 22,500. That is 700 will be the intrinsic value. 700 plus 0 is equal to 700. So you are buying this call option at 600 and you will be able to sell it off, or it will expire at 700. So your 100 rupees will be profit multiplied by the lot size, that is 7,500 rupees will be your profit if Nifty were to expire at 23,200.
Correct.
Did you understand this? Okay. So this was about call option premium. Okay. In the money, out of the money, at the money. Now similarly, let's calculate, let's understand the moneyness for put option contracts. All right. I'll just revise for call. For call option contracts, premium is equal to IV plus TV. Similarly, okay, now for call option IV is equal to spot minus strike. Okay, if IV over here for call option, if IV is equal to 0, all right, or close to 0, then that is the at the money option. If IV is greater than 0, then we will call that strike price as in the money contract. And if IV is in negative or 0, if it is in negative, all right, we will call it as out of the money option. Okay. Now for similarly put option. For put option, again the premium is equal to IV plus TV. Okay. For put option IV, it is a little bit different. Okay. What? It is nothing but strike minus spot.
Okay.
Okay. For intrinsic value of call option, it is spot minus strike. For put option, it is strike minus spot.
Okay.
Okay. So if the spot price is 23,000 and you select a strike price of, let's say, 23,200. Okay. So 23,200 minus 23,200 is your intrinsic value.
Yeah.
So then tell me, this IV where it is greater than 0, what will be this called as?
In the money.
In the money put option.
Yes.
Okay, but if you select a strike which is less than, that is 22,900, it will be, the IV will be minus 100, or you will take it as 0, and this will be calculated as, this will be what?
Out of the money.
Yes. So if IV, same thing. So if IV is less than 0, it will be called as out of the money. All right. And somewhere nearby, if you take a strike of 23,050, all right, then this will be called as at the money put option. So if I want to take you back to the strike platform over here, on the left hand side we have the calls, on the right hand side we have the puts. All right. So current market price is somewhere at 23,050. So 23,050 ka call is at the money. 23,050 ka put is also at the money. All right. Now if we take a call strike over here, that is the Nifty is below spot price. Spot price is 23,050 approximately.
Yes.
If we take any strike which is below 23,050, that is over here, all these are called as in the money options, in the money call options.
Okay.
And below this line, they all are called as out of the money call options. Similarly, for put option, these are called as out of the money put options, and any strike price which is above the spot price over here, for the put, it will be in the money put options. So I hope you understood the moneyness, right? Fantastic.
Thank you so much, Zubin. This moneyness and the concept that he has explained us through the strike platform and through his charts as well has been very entertaining and educating.
Great.
What the viewers have learned about it, let us know in the comments, and do like and share this video. Before that, you can go to our platform, that is web.strike.money. There we have a 7-day free trial period for everyone. You can go sign up there and have a very happy investing journey.